Hello friends, in this video I would like to inform you how to invest because many times people don't know what to do with their money, and I thought that this is important to clarify some of the doubts, especially if you're new to investment, whether you are 40-year-old or if you're 20-year-old or even 12-year-old. This video is going to help you because I'm going to tell you how you can invest, where you can invest, and why you should invest. So let's start our journey and understand what is money. When we talk about money, money is something which is like a cash which is always in your bank. And the problem with money is that if you keep it in a bank, then nothing happens. Actually, you lose money. Because if you have your money in your hand, for example, then it has something called inflation, and because of inflation the money that you have will keep reducing in value. So if you have the money in your hand, or suppose you keep that money in a bank account which does not give any interest rate, then over 10 years you will actually completely erode your money. Let's say, for example, if the inflation is 10%. So inflation is basically the amount of things that will cost, and it will keep increasing every year. And because of that, if you have say 100 rupees or $100 with you, after 10 years they will completely get devalued, and what you can buy $100 today, you will probably need at least twice or three times of that money to buy the same thing after 10 years. So because of that, because of inflation, you will actually end up losing money if it is kept in a bank. And even if you keep the money in savings account, you are still affected by inflation, because the amount of interest paid by the savings account is not in line with the inflation. If you look at the inflation, it is at least 5 to 6% when it comes to the inflation in India. But then there are countries where inflation is almost touching 10%, sometimes 12%. So if the savings bank account is giving you something like 2%, 2.5%, that means you are still losing money if you keep the money in savings account. So this is the basic difference in investment. And if you don't invest, even if you have money, you will actually end up losing money in a long term. So how do you stop losing your money? Well, I think when you want to talk about this particular aspect, you need to now start looking at something which can give you more money. So you start looking at certain saving accounts, hypothetically, which can give you at least 10% returns. So now this is not a real situation. You will not find a savings account which can give you 10% interest rate just to balance your inflation, because there is nothing like that. But just in case, if you are able to find a savings account where you can easily park your money, and it is giving you a higher rate of interest which is equal to the rate of inflation, then you will stop losing money. But you're not losing money. Your $100 will remain $100, because now it is giving you interest rate which is equal to annual inflation year on year. So after 10 years, your $100 will probably become $250. So this way you will stop erosion of your money. However, this is all hypothetical. There is no savings accounts which will give you that much of interest rate today. So therefore, you need to look at other avenues to basically grow your money. And these other avenues is basically when you talk about looking at other avenues, is basically how do you make money. And there is an old proverb: in order to make money, you need to invest money. So now we are talking about how do you deploy your money so that it multiplies. You are now looking at things where you need to invest money so that you can make money. Because if you don't invest money, then after a few years you will lose whatever you have. So you need to keep on investing in the market, keep on making sure that your money works for you, and it basically multiplies, so that over years it basically generate more money for you. Your money generates more money, and that is why we are talking about why we should invest money. So what is an investment? I think that is a $1 million question. Investment is something which can give you better multiplication or better compounding effect of your existing money, so that when you want money in future, you can go to your investment and take it out and basically buy a house, buy, invest in a company, go for higher studies, whatever may be your requirement at that point in time. However, investment is something where it requires constant monitoring. It requires constant, you don't want to make an investment which will go down and you will end up losing money. Now you wanted to invest money, but then suddenly you realize that that particular investment has gone bust, and even your initial investment has gone bust. So investment is important, but we need to make sure that we invest in the right thing. And some of the places that some of the countries where the housing is always a very good investment, so people tend to invest in housing, because housing, your house value will always tend to grow, whatever the economic situation in that country, until unless there is a complete failure of the state itself, but your housing value will keep improving over here. So that is a safe investment. So people basically buy house. You would need a lot of money to buy house if you want to invest in a house. And also, the housing is not completely problem free. It is rather problematic, because what happens is, when you actually you're buying house because you want to make sure that your investment grows, and in future, when your house value is 2 to 3 times, you should be able to sell off that house and make recover your initial investment. And while this is happening, you need to also take care of your housing loan, and then you have to rent out your house, probably cover the rental and pay the mortgage bill, and maybe there are taxation around it, so you need to pay taxes. So even if you invest in housing, it is completely filled with a lot of problems and regulations which you need to comply. It depends on which country you are in, but housing is not completely problematic. Although it is a very good investment, it actually tend to grow. It will never fail. It is an investment which has been tested, tried, and it never fails. The value of the land or your house will keep increasing. Well, there are basic difference between the type of housing also, but we are not going in too much depth, because I want to explain what you should be investing if you have just started doing investment. So as we discussed, that housing is filled with a little bit of problem, although it's a good investment. But that is where the investment in share comes in, because it has less problem, and it is like, you suppose you have a faith on a very large company, and without the hassles of maintaining property, paying housing tax, paying mortgage bill, if you have certain money, you can simply buy those shares, and you don't have to basically take housing loan in this case. And if you have trust on a particular company, then if the company grows, you will also make money by basically holding on to the shares or selling those shares after 5 to 10 years horizon. So this is where the share seems to be a better bet than housing. So far we have progressed from savings to housing to shares now. However, shares are completely linked with the market risk. Say, for example, if you have a share of a particular company and that company share drops, then you will also, your investment will also get dropped. And that is where the whole risk pattern which is running in your mind, because in your family somebody would have told you that, hey, this and this relative would have lost so much of money by investing. In fact, they have lost everything. So this happens when you actually invest in shares without having proper knowledge or without keeping track of the shares. Just like you have housing issues, shares, investment in shares also comes with bit of challenges, bit of responsibilities, and bit of monitoring. You need to keep monitoring the investment every day. You need to know exactly what is going on with that particular company. So this is where you tend to then spread, because now you're investing in one company, and then over time you start thinking, hey, why should I put all my eggs into one basket? I should rather invest in 5 companies, because even if one company fails, then I have at least 4 others to bank on. So therefore, the shares is basically a good viable option, and especially with shares you can also make money, because when you are actually a part owner. When you buy share of the company, you actually become an investor in the company, and when company declares the dividend, you get a portion of the dividend as your earnings. So you actually not only keep increasing the share value over years, you also tend to make money by way of dividend. And dividend is, say for example, if there are $100,000 a particular share value, and the company decide to give 1%, so 1% of whatever you hold, you will get as a dividend. So this is why a share is a very good opportunity, although it is completely riddled with market risk, and it requires a lot of monitoring. And therefore shares also tend to grow also, and it similar to your house, which grows along with time. If you hold on to your shares, share value will also grow, and it will also give you a capital gain. Say for example, if you have invested $100,000 over a period of time, the gain in shares without the hazards of whatever you have invested in housing will give you a capital gain very similar to house. But then in a house investment, you actually tend to lose in terms of taxes, in terms of various other maintenance charges, etc. Whereas in case of shares, you don't have any of those hazards. It will give you a capital gain benefit over the period of time. So I think a share market looks to be a better area for investment. And you should not be scared if you do it correctly. And I'm going to tell you, because nobody will tell you this, I'm going to tell you, if you are beginning to invest in the market, then follow these guidelines, which will benefit you even if you are a beginner. So as I was also telling you that it is not good to invest in individual stock, because individual stock can fail. So therefore you must look at other alternatives. So other alternatives are also available in the market. One is in the form of mutual fund. What is a mutual fund? Mutual fund is that you have you bunch of people come together and create a fund, and the fund then look at what 5 securities or 5 stocks to look at, and then they will actually invest in those funds, and the fund will keep increasing, and then you don't have to monitor, because now you're relying on the fund manager to invest your money. So instead of doing it yourself, spreading your money into 5 different shares, you actually go to mutual fund, which will do the same thing, but then it is taking away the hassles of basically monitoring the market. And they will not only invest in 5 stocks, they will probably invest in something like 50 to 100 stocks. So they actually even diversify your investment even better. So mutual fund is something that you can look at, and they are very good market products to consider when you're trying to invest your money. You can actually go to any of the publications. You can find which are the top mutual fund available in your country. In fact, you can go and make a search on Google, and it will give you top on the first page itself what is the best performing mutual fund in your country, and you can then close your eyes and invest your money, whatever small money, large money, whatever investment you want to make. Mutual fund is a much safer bet to put your money and invest and also grow. What is the even better option than mutual fund? Well, I will call this as an index, because in every country wherever there are stock exchange, they publish their indexes. Each stock exchange comes up with a daily index, and when I say 500 index, it's a specialized product that most of the developed country or even developing countries produce these top 500 index of 500 companies or the shares which are being traded on their stock exchange. And the first 20, you would remember them by name. If you go to the index in your country, you will probably see the familiar names like Apple, Google, and stuff like that. But later you start seeing names which you don't even know. But the top 500 companies which are being traded, and in fact the index will also tell you how much percentage of this company is contributing to 500 index. So pretty much if you look at the index, it is pretty much your country's economy. So now if you invest in an index itself, then you are actually spreading your money and diversifying so much, it is directly linked to your country's economy. So this is the best way to invest your money. It is even better than investing in mutual fund. So I would say that you must invest in the index fund, whichever country if you are in US, UK, India, whichever country you are in, look for the top 500 indexes. Like in India there are 2, and similarly US there are 2 indices. You can pick one and put your money either in one or both of them. Both of them are directly linked to your country's economy, and there is no way your country's economy is going to drop. There is absolutely, it will drop only in case of very extreme situation, that something is completely the earth is getting destroyed. Then only this will happen. Otherwise it will be completely safe, and you can rely on investing in indexes. Even though if it drops for some time, because market crashes on time to time, but then you don't have to basically panic and start selling if you're invested in index, because index will eventually come back after a few months to the original position and continue to grow. In fact, I'm trying to show you in this graph that the index will have these small dips time to time, but overall over a long range or long period of time, the index actually grows. So it is the safest bet if you want to put your money and make sure that it grows. And index also will help you diversify. I mean, it will offer you the best possible concoction or diversification, because you don't want to depend on 1 or 2 or 10 companies or even 100 companies. Now you're linking it to the top 500 companies which are literally driving the economy of your country. So your fund, your money is now equally spread, diversified enough, and you will never make any loss if you invest in an indexed fund. And therefore I would advise that look for index fund. In fact, you can use Google to identify which is the index fund. And index fund also, depending on which country you are in, it also gives you low entry fee, because in any product that you buy, whenever you buy a share or you basically buy a house, you need to pay certain fees, as part of your taxation. Similarly, when you buy a mutual fund, there is an entry fee. You end up paying certain fee like 1% or 2% depending on each fund. Similarly, indexed fund will also have an entry fee. So far what I've seen is that index fund asks for the minimum fee. So in terms of your investment fee that you need to pay is also less when it comes to index fund. So I think it is a safer bet. Now let us discuss the risk also. So risk is definitely there whenever you make an investment. You cannot overlook the risk, because there are market risk, and markets are driven by several factors in terms of change of technology, change of sentiment, wars, pandemic. So all of this will directly affect regulations, law and order. All of these will determine the market valuation. But then if you are invested in the index fund, the risk is less, because if you decide that your horizon is 5 years to 10 years, normally these things normalize over long period of time, and the share price or the economy keeps increasing, taking care of all other aspects like inflation and things becoming more expensive, etc., etc. All of this is taken care by the investment. And if you invest, especially for a long term, then the risks are definitely highly minimized. So we can discuss about risk, but make sure that you invest in the index fund so that you diversify. The whole equation is that you must diversify into several other securities and don't park your money in only one. So as I said, don't put your money in just one of the product, which is going to basically, then you end up losing your money. You end up making a loss. And don't look at a short term investment. Always look at, when you're looking at a stock market, make sure that you have a long term view of your investment, at least 10 years, at least 5. If it is like 2 years, 3 years, then it is not good enough for stock market. You may end up losing money, and that is the story that you might have heard in your family, that so and so have lost money. Your parents might have lost money. So in a stock market, make sure that you have at least a long term horizon of 10 years or even more than that. That will actually multiply your money many times. And in long term, the stock market always goes up. As I said, there are a lot of factors, and for stock market to completely come to zero is not there at all. Even during depressions, the market has always bounced back, and it has kept growing in last 100 years. So the stock market will always bounce back, and it will come back to the original place and probably grow from there. Now let's look at what is the right time to start, because right time to start is you would say, hey, I am just a teenager, I don't know when to start. So in my opinion, right time to start is as soon as possible. If you are invested today, it will be better for you. There will be a huge difference if you start investing at the age of 30 as compared to if you start investing in the market at age of 15. So the right time to start is as soon as possible. That is the shortest possible answer. So if you are young, it is a very good time for you to start investing in the stock market. And make sure that you have a long-term horizon. Don't look at your money on day-to-day basis, because that is not going to give you anything, because market will keep going up and down. And if you are invested in the index itself, then you don't have to look at your market on daily basis, because it will correct itself and it will keep growing. The economy will keep improving. Now there are certain conditions with regard to when you should start investing. The best time to start investing is when your debt is zero. Make sure that you don't have to, basically you don't have any liabilities on your head. Your debt is absolutely zero. So make sure before you start investing, make sure that you bring down your debt to almost zero. You don't have any liabilities, and then you approach the market. And that is the right time to start investing. For each individual, the best time is determined by themselves. So I'm just giving directions that whenever you want to start investing in the index funds, top 500 funds, or any mutual fund, make sure that you bring your own personal debt to zero. And don't invest 100%. You don't want to keep all your money in stock market. Keep some liquid cash for your emergencies. Usually the thumb rule is keep cash which will be sufficient, which will suffice your expenses for 3 to 6 months. And once you're able to divide that amount, then rest of the money you can actually invest. And therefore keep a buffer of 3 to 6 months expenses in your savings accounts or cash, so that you're not after 6 months you're not in case of emergencies, in case of any medical emergencies, you are now scrambling for money, and you don't want to break your investment in a short term, because you might end up losing money. So make sure that whatever money you invest for at least 10 years, minimum 10 years, your horizon should be minimum 10 years, and then you don't have to really look at it on daily basis like you must have seen in various movies that people are looking at every second. That is not the way in reality the stock market will work. You invest in index, top 500 companies, spread your investment, diversify, and minimum investment horizon should be at least minimum 10 years, and you would see that your money would double in 10 years, or maybe 3 times in 10 years. And now you have to look for a broker, because broker will help you put your money, park your money. In most of the countries, the stock markets are heavily regulated. They are governed by a lot of rules and regulations, and brokers are governed by those rules and regulations. They have to follow a lot of rules and regulations, and they will actually create these signed document. They will actually do your KYC. You will also have to go through a little bit of legal processes, because the broker, stock market, share market, they are all regulated. So you need to look at who's the best broker for you. You need to find which is the best broker. The best method to find the best broker is, you can actually put this question in Google: who is the best broker in my country? And then you can actually go and find that broker, maybe talk to him, find out what is his entry fee. And once you have identified these top 10 brokers, go by the broker which is asking the minimum entry fee for your investment, because ultimately you will make more money if there is less fee that you pay. So find the best broker, top 10 broker, and then identify which is asking you least amount of fee for your money. So if you follow these things which I have told you in this video, you will actually make up a wise investment for long term, and you will actually end up making a lot of money, and your money will grow over a period of time, and without the hazards of taxation, just like housing or mutual fund. You can actually go and make a lot of money. And it may, if your horizon is more than 10 years, 20 years, it may, your money, whatever you have invested, will become 5 times, 6 times, many times of your initial investment. So friends, do let me know if you have any questions, and I wish you all the best, and I will catch you in the next one.